Welcome back. Paul and I are here again, this time to talk about quantitative easing. We've had a little chat about inflation, we've had a little bit of a chat about interest rates, and of course most people think of monetary policy as being two components, the quantity of money and the price of money. So having dealt a little bit with the price of money, we now need to look at something which can affect the quantity of money, and that is quantitative easing. Quite a lot of people don't really understand what quantitative easing is, so perhaps I'll give you a sort of brief explanation as an academic of what I think quantitative easing is, and then Paul can tell me that I haven't really understood it fully, and there's much more to it than what I say. But I've always seen quantitative easing, if you like, as the expansionary side of open market operations. Open market operations was something that the Bank of England did if it wished to increase liquidity in the financial system or reduce liquidity in the financial system. And the way that you would increase liquidity in the financial system would be for the Bank of England to go into the market and buy second-hand securities, and that would return cash into the financial markets. And I see quantitative easing as being a similar process to that. So quantitative easing is the Bank of England going into the market, it's buying assets and it's paying for those assets with cash, which it ultimately creates itself, which is printed at its behest and turned into the market. If there was two sides to quantitative easing, there would be quantitative tightening as well, because open market operations were used and varied throughout the year. At certain times more liquidity was required in the financial system, say around Christmas or the end of the tax year, and less at other times. So open market operations would be acting to put cash into the financial system and take it out, whereas quantitative easing tends to put it in, and there's thought of quantitative tightening. I don't ever see it happening. There's also talk of tapering, which tends to be not maintaining, in my mind, the same amount of quantitative easing, but I'm sure Paul will explain these things a lot better than I have introduced them. So Paul, what's your take on QE? What exactly is it?
To understand this, really, one needs to just have a little bit of a lesson about how a central bank balance sheet works. The main liabilities of the central bank is what we call base money. It's the notes and coins. We typically use coins, usually not on the central bank balance sheet, it's the notes. And it's the commercial bank's balances held at the central bank. And those two are interchangeable. The commercial banks buy their notes from the Bank of England from those accounts, and they use these accounts to settle debts to each other at the heart of the banking system. And the central bank can decide how much of this money is created by adjusting the asset side of its balance sheet. And in normal times, what they would do is lend money to the banking system so that the right amount of money was there. If they wanted a bit more money in the system, they would offer to lend the commercial bank a bit more money. If they wanted a bit less, they would offer to lend them less. But if you get into a situation which we did in the Great Financial Crisis, where you wanted a lot more money in the system very rapidly, you can't really do it through lending. You can't make a bank borrow from you. Even if you're the central bank, you can't make the commercial bank borrow from you. So the alternative to lending the banks money is to go out and buy some assets. And you buy any asset you like. It could be pots and pans, actually. It could be government bonds. It could be equities. It doesn't really matter what you buy from the monetary point of view. You buy those assets and you give people the money for them. That money ends up in the commercial bank's accounts. Typically, you actually buy the things through the commercial bank, so it goes straight in. In fact, if the Bank of England is buying gilts, which are UK government bonds, they'll typically buy them off the market makers, who are the banks, and credit their accounts over at the Bank of England. So to rapidly expand the money supply, you go out and you buy a lot of financial assets. And in different countries it was called different things. We called it quantitative easing in the UK. The Americans didn't really like that. They tended to call it large-scale asset purchases. It's exactly the same thing. In Europe, they didn't really want to buy sovereign bonds because of the different countries in the euro area. and actually they started off buying corporate bonds. In America, because they had a problem in their housing market, they started off buying a lot of bonds backed by housing assets. And those things, when you buy private sector financial securities, we tend to call that credit easing, because you're influencing the spreads in those markets for those particular financial assets. But so whatever name it goes by, the main thing is you're expanding the money supply, and you're expanding the money supply by buying some financial assets. And that's the crucial thing. There's actually still very little discussion, surprisingly, about what the right assets are to buy under quantitative easing. It's one of my research areas I'm writing about at the moment, because I think you can do all sorts of things by changing the composition of the assets. The main things for monetary policy is you want to increase the supply of money by buying a lot of assets and doing so quickly.
Right. Now, was I correct in saying that QE is just like the expansionary side of open market operations? Because you use the word lending and buying notes, whereas I always saw open market operations just as a process which it was thought we need more cash in the system, and therefore the government was doing, the Bank of England was doing exactly what QE does. It just bought assets to push cash into the system. It didn't actually respond to what the banks were asking. It was just part of its policy is we need more liquidity in. And in that sense, I always saw open market operations as being very precisely just pushing cash into the system in the same way as QE is.
It's very similar. We typically used open market operations to refer to smaller scale operations. And when you lend money to the banks, you don't lend unsecured. You normally lend against collateral. So typically what will happen is you will lend the bank some cash, and it will give you some of its financial assets to hold as security. Well, there's actually not that much difference between doing that on a temporary basis for the duration of the loan and going out and buying that security in the market permanently. And actually we always did a little bit of buying and selling in terms of our operations, so that we could adjust how much of the adjustment we had to do in lending. So there was always a bit of a mix. What was new was really the scale rather than the nature of the transactions. But it's all open market operations in that sense.
Yeah, I mean, one of the interesting things which has just come to mind now as we talk about this is that when I was teaching this a long time ago, we explained that open market operations were all done in secret. No one actually knew what was going on. The government had a broker, and no one knew who that. Well, obviously some people did. No one knew who that broker was, and open market operations was basically done in secret. Whereas because of various changes about transparency, quantitative easing became much more something that people saw and were told about, and this is happening. And I think it's got, in some senses, a bad press because people know about it, whereas open market operations never had the bad press because no one ever knew about what was going on, whereas now they do with QE. Was I right to think that? Or?
I think so. It's still the case that we don't say who we're lending money to when we lend, and we don't say who we're buying the assets off when we buy.
Right.
So there are still some things which are not revealed because those are commercially confidential relative to the particular banks. And particularly if you're lending one bank quite a lot of money, people might think it's got a problem, and so they really don't want their names being in the frame. But for the Bank of England has always published the total size of its balance sheet, and so it's always been possible to see, with a lag, the total size of what's going on. Actually now it's become very explicit because the regular weekly report from the Bank of England details the monetary operations very clearly, so you can see what's going on. But yes, nobody paid any attention to it before. It was typically quite small.
Yep.
It didn't really matter. Going back to before the financial crisis, the amount of commercial bank balances at the Bank of England was tiny. The balance sheet was dominated by banknotes, not by commercial bank balances. I can remember figures of around 70 billion for UK banknotes in circulation, and about 18 billion, I remember back in about 2006, for commercial bank balances. Well, you're now into hundreds of billions for commercial bank balances, so it's increased by more than an order of magnitude.
Yep. So I suppose that does really lead us into this this next question. I mean, QE was something we hadn't heard about until there was a global financial crisis. would you sort of like to explain why, after the global financial crisis, QE was really necessary?
Yeah, there were two things going on. One is the economy. We ran into the financial crisis, and the economy sank very heavily. Action was taken to try to limit the extent of that weakness. But once interest rates got close to zero, well, what do? It's very difficult to impose negative interest rates. People don't have to hold their money in bank accounts. They can just hold cash, which has a zero rate of interest. And we actually did calculate sort of how big a warehouse you'd have to put the cash in for people to take all their money out of banks and put it there. So one aspect of it was stimulating the economy. But we also had a situation where one of the reasons for economic weakness was the banks, we thought, potentially all the banks, major banks in the Western world, were bust. They certainly weren't lending to each other. They couldn't get liquidity. People were trying to protect their own balance sheets. They weren't participating in financial markets. The system needed a lot more liquidity. And one of the things about QE is when you buy the assets, the cash goes around the system and ends up on the commercial bank's accounts. They have no choice collectively. They might try and shuffle it between themselves, but they can't collectively change that stock of money. That's the central banks under control. And so we basically forced the banks to hold all this extra liquidity through doing QE. And that did fairly quickly actually resolve a lot of the panic in financial markets between the banks. You saw exactly the same happen in March in 2020. There was a bit of a panic in financial markets, liquidity dried up, the big central banks came in and announced new QE programs, and within a matter of about 24, 48 hours, the panic had ceased. So QE does certainly operate much more effectively, you can see, during the times when markets are in a panic, in a crisis, because it calms everybody down, because they all know there's going to be plenty of liquidity in the system. They don't have to borrow from each other or get it anywhere. It just comes at them from the central bank's operations, and that immediately now will calm things down. So it started in the financial crisis for these two concerns. One is we had a financial market crisis and we needed more liquidity in the system to calm things down, and we had cut interest rates close to zero, and we couldn't really go any further to stimulate the economy.
Good, at least that is exactly what I thought, having sort of read the theory of the way that these things were going. There's a lot of criticism of QE now by people, I think, who don't quite understand what QE is and what QE was. And I'm quite happy to justify QE for no other reason than after the global financial crisis there was a great threat of deflation, and I've already said in a previous chat that deflation is much more damaging than people may think, and that the Bank of England did avoid deflation with that QE programme, suddenly pushing money. As Paul said, interest rates going down should have encouraged expansion and more people to borrow, but at a time when there's a financial crisis, when banks have stopped lending to each other, each bank looking at the other bank going, I wonder if you're the next one to go down, and there are a lot of problems. QE overcame that. QE pumped money into the economy. In retrospect, I think it pumped too much money into the economy, but then that's something that you would never know until you did it, because as Paul has said previously, nothing about this is precise. We don't know this amount on this day will do that, but we do know we've got to do something. And therefore, if you're worried about deflation, you want to avoid deflation, you want to try and get back to target inflation, how much do we put in? Well, nobody really knows, so let's put a little bit extra in just in case. And I do remember inflation very quickly pushing up to just under 6% after the big first bout of QE. So it was obviously doing its job. It obviously dealt with the problem of deflation. But then I begin to worry about whether or not it's still being used to manage, if you like, the average level of prices, or is it now being used, and is there a feeling with QE that we could do a lot more? We can QE to grow the economy, we can QE to solve a pandemic, we can QE to do anything we like. Do you think QE's overthought in that way?
Well, sadly, John, I think we agree very much about this. I mean, now
We
each
can't have an argument.
each MPC member has their own views about QE and how things work. But when I was a voting member, it was very much exactly as you suggested. We were on a dilemma. We didn't know how much QE to do. If we'd done too much and that had ended up causing inflation, well, you could have sacked all the MPC members, put some more hawkish members in, you could have been appointed. Interest rates could have gone up, you stopped doing QE, you would have brought inflation back under control. But the system would have still worked. You could still have had the inflation targeting system and everything that goes with it. If we did too little and we got stuck into deflation, as Japan had previously for a decade and a half, we didn't know what you would do in those circumstances. The system itself would have been bust. And so the risk was very one-sided. We were doing QE to stop deflation, and it worked. Now, we ended up doing a lot more QE than we might have expected to do to stop deflation. And it was a bit of a puzzle at the time why we didn't generate more inflation, but we didn't, thankfully. We had a couple of near misses, partly on the back of high oil prices, and you could argue that the QE we had done allowed oil prices to influence inflation rate, but the inflation rate duly came back down again. Where I have my concerns, it's about the attitude, particularly in continental Europe, where they have, and some UK commentators, where they have used QE to try and stimulate economic growth. And it was never really designed for that. It's not at all clear that by pumping more money into the economy, you can raise the real growth rate. And what's happened is, other things have happened which have taken away some of the effect of QE in terms of inflation. But the problems of slow growth rates in Western economies are much more to do with productivity, real competitiveness, the way we organise ourselves, and much less to do with monetary demand. And governments have not been taking the right action in order to improve the supply side of their economies. And I think that's particularly so in continental Europe. So some people have said, oh, QE is the only game in town. And I disagree with that. It's the only game that's been played. But it's not the only game in town, and there are some parts of the system which have gone missing in action.
Right. So do you think then that QE should stop? We should stop talking about QE and say go back to a simpler system where central banks manage liquidity, back to, if you like, open market operations and small actions to manoeuvre the economy a little bit forward, a little bit back? Or do you think QE is here to stay? Or do you think QE is here to stay, but you wouldn't like it to be here? You personally think that it's got a shelf life and that's it, it's done its job, let's move on?
I think it's a very interesting question. And again, I think there are different... I would defend the UK's position more than I would some other countries. In the UK, we did QE in four noticeable times. First of all, in the great financial crisis, when markets were panicking. Secondly, at the height of the Eurozone crisis, when markets were dysfunctional, not quite panicking quite so much, but they were. Then they did it as a precautionary measure around the Brexit referendum and outcome. I'm not sure that was necessary, but markets remained calm when they might not have done, so you can sort of argue it worked. And then it was done again at the start of the pandemic when markets were panicking, and it helped. Now, the problem is the amounts of QE that had to be done each time have got bigger and bigger, and the effect has got, if anything, less and less. I think we need to keep it in the box for these crisis periods. The real interesting question is, how big does the central bank balance sheet need to be? How much stock of money do we need? And that's when we get into a different question, because what we've done since the great financial crisis is dramatically increase the capital and liquidity requirements for the banking system. We are making the banks hold more liquid assets. The most liquid asset they can hold is their balance at the Bank of England. And so we've made the banks hold these assets and then given them the assets to hold. That means the demand for commercial bank reserves has gone up. Therefore, a lot of the stock of QE is permanent. At least as long as it's permanent, as long as we maintain these higher liquidity and capital requirements of the banks. We saw this in 2019. The Federal Reserve started to shrink its stock of QE, and they hadn't gone very far when they started to get volatility in interest rates. And that was a sign that the money stock was getting too small, and you started to get the corresponding volatility in short-term rates that you would go with that. And that happened much quicker, I think, than most people were expecting. So a lot of the stock is I think, semi-permanent. It could go down a bit. I think it will be good to get back to interest rate control rather than to control normal monetary policy through QE, because it's so imprecise. I went on record once as saying £25 billion was neither here nor there. I regretted it instantly afterwards. But that's the sort of mentality you get when 25 billion doesn't make that much difference.
Yeah.
That's not a very good means of
Yeah.
controlling the economy.
Because something you explained to me some time ago with QE was that if we wish to maintain QE at, we're at 895 now, aren't we?
Yeah.
So if we wish to maintain QE at 895, you've got to continue that buying process as proportions of that mature.
Yeah.
So that there will be continual injections of cash into the system to maintain 895. So there's an issue about whether you maintain 895, increase 895, or taper away 895 to smaller numbers, even back to zero. You're not quantitatively tightening under those circumstances, are you? You're just not adding as much as before.
Well, you are reducing the money supply when you reduce the stock like that. So the UK again has done it differently from Europe and America. When we've done QE, we've announced a fixed amount. That was just the way we happened to set it up.
Yeah.
Then we've completed that amount and stopped, but we have replaced maturing assets, and that means you each time the money stock goes up and stays at that new level, and we've maintained it there. And when the time comes in the UK to run down that stock, first of all, the thing to do would be to let stuff mature. You don't necessarily need to go out in the market and sell it. You could just probably take 10 years and allow it to run off. In the Europe and the US, they've got themselves in a bit of a pickle because they just announced buying programs, which is a certain amount per month, not quantities to add to the stock.
Right.
And so for them, tapering means they start to buy less. That means they start adding less to the money stock. And that was in itself became a market event. And so it's a slightly different thing. It's much more difficult for them to alter what they're doing because they didn't put a limit on the stock. And we've taken the stock approach in the UK. And there's arguments about whether is it the stock that matters or the flow. And I certainly think it's the stock that matters. But Europe in particular has got itself into a regime where it seems to be the flow they think matters. And that's much more awkward to get round.
Yeah, flows tend to stabilise, don't they, over time, and you wouldn't expect them to suddenly expand and contract too much, and therefore it will be the stock you would look at. The stock should make the adjustment, and the flow should be something that is reasonable and stable.
But the UK can stop making net additions much easier than the ECB and the Fed can, because of the different way we've announced and carried out the policy. I think that's better, because it enables us to not overdo the QE if we don't want to, and it will make it easier for us to run it off when the time comes.
Right. Let's just talk quickly, as sort of two economists. As two economists, we would know that if you wanted to avoid deflation, if you wanted to stabilise your inflation, something we spoke about in a previous chat, ideally you would like the monetary demand, which is the stock and the flow, you'd like it to grow at a rate which is 2% higher than the rate of growth of output in the economy. So you do need a mechanism under those circumstances, don't you, whereby the central bank can either manage that expansion through private banking, or it can instigate it through its own quantitative easing program, or whatever it may be. Do you see a situation where a central bank should be looking at a long-term stable program for expanding monetary demand at a rate which is, it sounds like simple sums, doesn't it, but a rate that's 2% higher than the expected rate of growth of output in the economy? And is QE the way of doing that? In other words, a quantity of money control rather than a sort of price of money interference, I like to think of, I'm afraid to say.
I think it's coming at the same thing from different directions. The hope is that the economy should grow at its natural rate, whatever it is, maybe 2% in real terms.
Okay.
And if you can convince people that the inflation rate is going to be 2% and set interest rates accordingly, you should get out the natural level of money growth that's consistent with that. What we're faced with, though, is a couple of things going on in velocity of money, which are very uncertain. One is the declining use of money for transactions, which you discussed earlier, but maybe an increased use of money for precautionary motives. But then you've also got the risk of disintermediating the banking system, and that's going to change the concept of money somewhat. If we could find that commercial banks disappear completely and other financial institutions take their place, and we don't really know what that's going to do to the monetary system. So now we're entering a time when it would be actually very difficult to set monetary targets, for example, because we don't know how the structure of the system is going to change and how that will affect the velocity of money. The principle you describe is actually fair, which is you want the growth of overall nominal demand to be about 4 or 5%. But actually, how you engineer that using your monetary policy levers is going to be the tricky question. And I think a lot of it will come by sort of trial and error, effectively. We will be adjusting the parameters, the QE stock and the interest rate to try and get the right outcome, and then altering it a bit if we don't get the right outcome.
Yes, that's right. And I think there is, in some senses, a problem ahead there, because if the central banks get it right, then we should get back to a stable environment for inflation and money being used to absorb the growth in the economy as we all become better off. But if it doesn't get that right, we're probably opening the door, aren't we, to the digital currencies, the cryptocurrencies that are going to say, no, use these. Don't use central bank money because they're getting things wrong on. I suppose that's something we can talk about in another chat, isn't it? I think we've probably run out of things to say about quantitative easing. So I hope you've enjoyed quantitative easing, and we'll come back with another chat soon. Thanks, Paul.